Good evening, and thank you for attending this evening's webinar, Post-Election Investment Strategies, performed by OJM, the Wealth Management Team. For those of you that have attended prior webinars, this will be an abbreviated version. I would expect us to spend roughly half an hour with you this evening. Quick bio on the two of us that will be presenting. My colleague Kim Renners will be speaking. Kim's been with OJM for several years, and I don't think that she would appreciate me stating the length of time that she's been in the industry, but her background prior to coming to OJM, she managed about $4.5 billion for a regional insurance company. And myself, my name's Andrew Taylor. I'm a certified financial planner, and I've spent the past 15 years working with high net worth individual investors, and I was solely responsible for a practice of about $425 million in client assets. So on to the topics for this evening. So we're going to address a few different matters. First, how did we get to the fiscal cliff? There are actually two separate issues that we're going to be dealing with in the next 60 days, so we are actually lumping them together. What to expect, this is our opinion on what's going to happen. Keep in mind it is just that, it's an opinion. Attempting to predict what the government's going to do is like trying to forecast the next action of a couple of toddlers. So again, we are going to give our best educated opinion based upon the research that we've done. We'll spend a few moments going into our favorite investment strategies. Now, this will include planning strategies, and in addition to what we feel will be tactical opportunities that can add value to the portfolio. This isn't necessarily the hot stock tip of the day. We're going to leave that to Jim Cramer and his hollering that you are able to hear through your big screen TV. So at the very end, we'll give you the opportunity to ask questions. I mean, feel free to submit those throughout the course of the presentation, and then we will address the questions that we have received at the end. So like any investment presentation, we will have to give you the standard disclaimers. The important takeaway here is that everyone's situation is different. At OJM we provide customized planning, not solutions in a box. So what we have come up with here are suggestions that we feel like should apply to most of our clients and our prospects, but it is important to have a personalized discussion either with us, your tax professional, or some other expert prior to acting on some of these items that we're going to address. Just a moment on who is OJM Group. Who are we? For those of you who may not currently have a relationship with us, you can see all the areas in which we feel like we have a strong level of expertise. By definition, I would say that we're a comprehensive wealth planning firm. We have experts in-house that specialize in tax planning, asset protection, business, also known as entity structure, in addition to investments. One person can't possibly be an expert in every one of these areas, so our talent on hand performs only the activities in which they are an expert in and deal with on a day-to-day basis. For anyone who is listening this evening, we do offer we do have a gift for you this evening upon request, and that would be a free book. You can see our niche here, and give it just a moment to pop up and you'll see. Our niche here obviously has been with physicians. Most of the books that we have written are geared towards doctors. However, they're not pictured here, and also available as a book titled Wealth Secrets of the Affluent. So if you're interested in any of these, please let us know, and we will certainly be happy to send you a copy of one of these documents. The OJM Wealth Management Team, and I think I'll just spend a moment on what makes us unique and I think what makes us different. A few of the key items that I will hit. The institutional approach to investing. This is the approach that's utilized by some of the largest endowment funds. We have implemented that strategy with really placing an emphasis on the non-correlated alternative investments. How can we add value and generate return, generate what they call alpha in our universe without taking on excessive risk, and try to limit those volatile swings that many clients have lived through, unfortunately, more than once in the last 15 years or so. And then the other component of what we do is actually executing and implementing some of those strategies that were suggested by some of our other experts as it relates to estate planning and tax planning. We certainly are not going to let taxes dictate our decision-making process, but we provide that comprehensive planning to our clients, and it is executed within our security selection process. So on to the content of the presentation. I think it's worth spending a moment on how did we get here, and exactly why are we facing this fiscal cliff. There are a couple issues that I mentioned earlier in the presentation. We had both the expiring Bush tax cuts, and then we are also about to reach the federal debt ceiling, and we feel that those two are very much tied together. So I think it is certainly worthwhile to address each of those matters. We've had years of inaction by Congress. We've had the financial crisis, which was not only the banks that have gotten so much press, but we also had the issues with the lending institutions, Fannie and Freddie, the automakers, and we haven't necessarily recovered all of those losses from the financial crisis. With our attempts to stimulate growth or the tax cuts that took place. The wars are extremely costly, and then we'll also get into the demographic trends, which is the aging of the baby boomers, which puts some pressure not only on Social Security, but we also have health costs that are rising substantially. Our next slide gets into the debt drivers. We know about all of the issues on the left because we've lived through them. These are more of the shorter term issues that we have dealt with that has caused the level of debt that we have to escalate. But I think the bigger issue that we're dealing with at this point, the reason why it's gotten so much attention in terms of just the fiscal cliff and the deficits that we're dealing with are, where are we headed? I mean, long term, we have rising healthcare costs and an aging population. We don't have significant revenue, but the thing that jumps out that most aren't aware of, I think, when I look at this slide, are the growing interest costs. Realize the 10-year Treasury today is only at about 1.6%. It's been trading between 1.6 and 1.7. So the cost for our government to borrow is really as low as it's ever been. We won't have rates at that level forever. We just simply can't. So, as we continue to grow, we may generate more tax revenue, but our interest costs are going to soar. And the next page is going to give us a graphical illustration of exactly what that looks like. The problem again is where we are headed, and the revenue piece isn't the easiest to read. If you look at roughly year 1999, you see that the line that peaks above the others actually represents the revenues that we have achieved, and it may be difficult to tell to the right of the vertical line, but every single one of those categories is increasing over the course of the next 10, 20, 30 years and beyond. But the one that really jumps out, obviously is the interest cost. So, we have to get the debt under control because the cost to service that debt is only going to grow and grow substantially. Next slide will give us, I think it's very valuable because it gives you a sense of the issues facing Social Security, and I mean, this is almost breathtaking. The ratio of workers to retirees, clearly we do not have anywhere near the number of individuals putting into the pool as ones who will be actually withdrawing and taking out. So this is a significant issue. I mean, Social Security is going to be underfunded in a matter of less than 10 years and basically bankrupt in the next 15 if some kind of action is not taken. So you can see the dire strait that we may be in there. And then the next slide will be just another illustration of the interest. I mean, the numbers only mean so much in terms of from a straight dollar perspective, but the way it needs to be evaluated is, taking into account taxes, inflation, and growth. Well, where is it relative to GDP? So, the type of revenues that we are generating, what percentage of what we create and make and how we grow. What is interest? How is it represented as an expense that we face? And you can see it's getting out of hand. And 6% isn't certainly significant, but 32% of GDP in 2013 and 44% of GDP in 2050 are really frightening numbers, and it really would have a negative impact on our status as a global power if most of our expenditures are going to to the interest on our debt. So what do we expect? I mean, what do we anticipate will happen as we move towards the the last 30 days of the year? Well, again, it's difficult to predict, but the next slide we'll get into the economic impact of falling off the cliff. So here's the bottom line, is that if we do fall off that cliff, we'll have a 4% reduction in GDP. The most recent GDP numbers that were revised in the last day or two, we suggest that we grew at a rate of 2.7% annually. So a 4% drop in GDP says that we'll have negative growth, and by definition, that is a recession. We'll also have higher unemployment. I mean, higher taxes simply means higher expenses for smaller businesses, lower budgets. It's also less money in the consumer's pocket. Consumers make up approximately, or consumer spending makes up roughly 2/3 of the economy. So, that obviously is an issue that has to be dealt with. It's certainly a concern. And my personal opinion is, and maybe I'm an optimist, but I just don't see us falling off the cliff because there's too much at stake. So again, back to what do we think will happen, our opinion on some of these key items, which is on our next slide. A grand bargain is highly unlikely in 2012 or at the end of this year. I had the opportunity to hear Erskine Bowles and Alan Simpson speak, part of the Simpson Bowles Commission, when I was in Chicago 2 weeks ago, and they basically gave a 1 in 3 chance of a grand bargain occurring. Congress is simply not in session enough days throughout the remainder of the year. I think there are 10 days where they're meeting to get a complete restructuring of the tax code. Just simply is not likely. So what exactly happens? We'll probably see an extension of the Bush tax cuts for most individuals into next year. Now the question is, what will happen for the majority of individuals who are on this call, those who make in excess of $250,000, and there certainly is a chance that we will see the taxes increase for those individuals. When we're talking about individual income tax, we may very well go back to rates of 36 and 39.6 rather than the 33 and 35% rates that those individuals are paying at this point in time. In terms of the actual reduction of the deficit and more comprehensive tax reform, Congress will get started on that very, very early in the year. And this will involve some combination of, higher individual tax rates, fewer deductions, and an increase in investment taxes. So, the bottom line is it's highly likely that we're going to see higher tax rates in 2014. 2013 is unlikely to be that significant in terms of an increase. At least that's the way the winds are blowing right now. We could certainly see a change, but the Republicans are willing to accept higher revenues, and their desire is to do that through fewer deductions, basically. Whether or not that happens remains to be seen. So one last point on dividends and capital gains. I mean, right now those figures are at 15%, long-term capital gains and qualified dividends. It is likely that we'll see those settle, in the next year or two, somewhere in the mid-20s. I mean, unfortunately, they're going to go up. Whether or not that happens in 2013, I don't think it's that likely. What will go into effect is that 3.8% tax assessed on, what they call the Obamacare tax to continue to fund Medicare on those who have wages in excess of $250,000. So So is the fiscal cliff a good thing? I mean, it could improve the situation in the long term, but some of the negatives are, at the end of the day, increase in taxes will decrease incentive to earn more and to grow and develop and innovate, and that's certainly not a good thing. But the bigger issue is that the fiscal cliff, the way that it's currently structured, doesn't really deal with the longer term issues, which is the Social Security and health care. The revenue would come from the higher marginal rates, but again, that creates less incentive, for those to strive and be successful. And mindless across-the-board cuts are what are scheduled to take place, and that certainly doesn't benefit anyone. Why it's unlikely and why we don't feel like the cliff will occur, will fall off this cliff. If we jump to the next slide, we'll see some of the key reasons. I mean, public demand. I think individuals have spoken. Simpson Bowles, they have been very, very vocal in, their agenda. They have a website called fixthedebt.org to try to, petition individuals to say, what, we have to get our fiscal house in order, but we cannot allow ourselves to fall off this cliff. I mean, Bernanke has been in front of Congress and says, I'm not saying that you can't raise taxes, but you can't allow us to fall off the cliff, at least right now, that our economy is too fragile. We have unemployment approaching 8% and growth well below 3%. So you can't have these significant across-the-board cuts. And then the other reason why there is some optimism for getting a deal done, I mean, history suggests that, a president tends to have a little more power and influence in the second term. Whether or not you like President Obama, the fact is he is going to be in office for the next 4 years, so that gives him some more leverage. And we can take a look at the Clinton administration. I mean, there was a period in his first term where the government actually shut down, and he was able to successfully negotiate with a Republican House and a Republican Senate. So I think that there's enough reason to believe that, that we will not fall off the cliff, because there's enough support, externally to suggest that it should not happen. But be prepared. There will be volatility in the markets. But our portfolio is designed to deal with the most likely scenario. I mean, one result that's not addressed here of the election is the fact that the Fed will have their foot on the gas. Romney made it very clear he was not a fan of the Fed. He was not a fan of Fed Chairman Ben Bernanke. His term is actually up in January of 2014. He will certainly have the option of another term if he wants to do so, and if he chooses that he does not want to continue in his role as Fed chair, a like-minded successor will certainly replace him. And that gives us a pretty good sense of where interest rates and where the Fed will be, putting their focus in, through 2015. So that provides a transition to our favorite investments and our favorite strategies, and that will give me an opportunity to turn it over to my colleague Kim Renners.
Great, thanks, Andy. Thanks, great presentation there. And just to let everybody know, I think Andy was actually kidding when he mentioned Jim Cramer, so keep that in mind. And the 24/7 news cycle is not really great for the market. And we've seen that, I mean, actually the past 3 days, where we have the different, speakers, president, whomever come out and make a comment about the negotiations coming into the end of the year, and the market reacts either to the positive side or to the negative side, just based on that one comment, that one smile, that one, wave. So please don't get tied up in the 24/7 news cycle, because we really think that's the worst thing. That's what, as investors, in the human nature, that's what we tend to do wrong, is overreact to, whether it be the positive or the negative side. Andy mentioned that we manage assets at OJM Group, and we manage about $250 million, across a number of households at the firm. And we've learned from our experience, and we educate our clients to that exact sense, like, just, guys, don't pay attention to the news. We have to have a long-term plan in place. Like Andy said, there's going to be noise in the interim. We expect that. We've had it pretty much every day this week. I mean, actually today in the stock market, we were down over 100 points on the Dow. And after some discussions publicly by some people out there, the Dow went up over 100 points. So you have these major fluctuations that you just have to watch out for, and don't panic. We all have long-term strategies. We work with advisors for that reason. We tend to keep our clients grounded. That's really our job. So with that being said, the title of this presentation was "You Don't Want a Lame Duck Portfolio." So what can we do, looking forward here over the next 6 to 12 months to properly position ourselves, to weather this storm if there's going to be a storm, or to capture a lot of upside, should that occur as well, because that can. Should there be some sort of grand bargain deal that Andy discussed, stocks could rally 1,000 points on the Dow. And so we need to be prepared for either that or, stocks falling 500 points or 800 points on the Dow. So as you can see on this slide, these are some of our favored investments going into year end and really going into next year. As Andy mentioned, all of our portfolios are very specific to all of our clients' needs. And so we'd always want to make sure we understand their risk tolerance, their objectives, their goals to retirement. But within that, what can we do? Well, what we typically do is we always build out a core of a stock, bond, cash allocation. But on top of that, what you're going to see in our portfolios are what we term alternative investments. And those investments are really going to be, here on this page, an example would be gold or non-traded real estate deals. Because those two types of investments not only diversify your risk and your returns in your portfolio, but they don't act and they don't perform in the same direction as the S&P 500. So that's really our benchmark for saying, okay, what's an alternative? Okay, it doesn't have a correlation factor of 0.5 or more with the S&P 500. So let's run through a few of these real quick here. So, the first bullet point I have says dividend-paying stocks. And it's been interesting, again, to hear, what is displayed and talked about on the news stations as far as dividend-paying stocks. So dividends may go up, right? They could potentially go back to ordinary income tax levels like they were before the Bush tax cuts were put in place. That would be tripling, right? What has happened historically is what we should say when tax rates were increased. Historically, big changes in the tax code don't have an effect on dividend-paying stocks. Fidelity recently put out a study, and it said about 1/3 of the U.S. dividend-paying stocks are held in qualified accounts, right? So those are IRAs, 401ks, 403b accounts, and 13% of these stocks are held by foreigners. So in those situations, they don't have a U.S. tax bill due, if tax rates go up. So therefore, you're not going to have that big change or big, decrease in the price of dividend-paying stocks because of the way they're held, the account, the type of account they're held in, or the type of investor that holds it. I mean, if you think about it, the fiscal cliff in general will be a big. If we fall off, it's going to be a big deal for stocks. Stocks are going to trade to the downside. Dividend-paying stocks historically don't have as much volatility as a typical company in the S&P 500. So again, dividend-paying stocks are going to be an okay investment. We like that investment for a portfolio. That's a core investment for the portfolio. Don't go running, from this investment. What can you do maybe if you have a qualified account like an IRA versus a taxable account in your joint name with your spouse or your individual name or your LLC name? Maybe just be very aware of the tax or the asset location, as we like to call it. So, buy more dividend-paying stocks in a qualified account so you don't necessarily have the tax consequences. Buy more tax-efficient investments in your taxable accounts. That leads me perfectly on to my next item here, the non-traded real estate investments. So what are these? They're very similar to publicly traded REITs. They're SEC-registered investment funds, but they don't trade on an exchange. So therefore, they don't have the volatility. They have very similar tax features as a publicly traded real estate deal, where a lot of the income that comes in to your pocket in your portfolio is very tax efficient, because instead of it being treated as ordinary income in the year received, it may reduce the cost basis in your shares. Because these are not traded securities, or they're securities that aren't traded on an exchange, you don't have the volatility, whether it be to the upside or the downside. We actually work with 6 different sponsors that build portfolios of real estate, whether it be a CVS and a Walgreens, whether it be a headquartered buildings for the New York Times, whether it be another type of office building, apartment buildings, and they put these portfolios of real estate together. They raise money from the investors like us, from our clients. They typically pay a dividend yield, 6.5%, 7.5%, that's very tax efficient. And on top of that, you're not going to have the volatility of your share price because of what may be happening in government, or what may not be happening in government. Again, a very favored investment of ours right now. Municipal bonds, you probably have heard of these. You may own some of these. These are bonds, debt instruments that a state or a municipality might offer. They're going to pay an interest rate, and that interest rate is typically exempt from federal tax, may even be exempt from state and local tax, depending on the state that you live in. And so, these types of investments aren't going to be home runs for your portfolio by any means. They're going to give you, 2%, 3%, 4, 5% per year of return, depending on interest rates, depending on the price performance. But this is a great diversifier. And on top of that, another good investment to have in a taxable account, should you have some assets that you manage outside of your IRA accounts. And gold, I think one of the biggest questions that we've been asked lately is, Andy, should I buy gold? What do you think about gold? What do you think about gold stocks? Well, what we've always said is gold is a great diversifier in your investment portfolio. We've run some analysis where it actually improves the risk-adjusted return by, reducing some equity or bond exposure and adding gold exposure into the portfolio. And so we really believe it makes sense. Do I say buy 100% gold? No way. That would be silly. But every client probably should have some sort of allocation to gold. Again, depending on your particular situation. I did skip over one point here about specific stock sectors. And as Andy said, we don't try to time markets. We build core portfolios, do some trading around them, to add value in a monthly or quarterly basis, annual basis. We always do rebalancing. But there may be some stock sectors out there that might make sense with the new administration. As you can see what we listed here, housing, commodities, and healthcare could be a couple of those, just based on where the economy is today, where some of the regulations are going in the next couple of years. The best way, in our opinion, to get access to these types of sectors are typically through, an exchange-traded fund that might buy all healthcare names or all commodity names, or you can even buy mutual funds that do the same thing. Mutual funds are typically going to be a little bit more expensive. You can buy individual stocks, but we always say, you really have to have a portfolio, probably over $1 million, to start investing in individual names, because your concentration risk at that point becomes a little bit greater than the need to hold that individual name. So these are really some of our favorite investments that we've been using in a lot of our client portfolios. Here's another more strategy. So again, a lot of people have come to us. We've been having these conversations on a regular basis. Hey, Kim, Andy, tax rates, looks like they're going up for me in 2013. You know, I have these assets that have appreciated over the past couple of years. The market's done great. What should I do with them? You know, should I sell them and just pay the tax now at 15%? Or, you know, should I hold on to them? Should I, if I have something at a loss right now, should I take that loss? All great questions. Again, all very specific to your situation. But here, remember, if, you know, if there's no agreement reached and the Bush tax cuts expire, cap gains rates at 15% today go to 20%. And then anybody, you know, here on the webinar, anybody in the United States jointly making over $250,000 a year with their spouse is automatically, we know almost with a certain, is going to be taxed at an additional 3.8% surcharge because of the health care reform bill. And so that's going to take your cap gains tax rate to potentially 23.8% in 2013. So should you sell assets today if you have large gains or to just pay less tax? You know, probably a pretty good idea. You know, we really think it makes sense. You know, we have different examples of clients who've, you know, had a lot of gains and a little bit of gains, and the different discussions that we've had with them. But, you know, I guess one point to note would be if you're planning on utilizing this cash, or if you're planning on selling this investment within the next 2 years anyway, absolutely. Get it done as soon as possible. Get it done now. Don't wait until the last week of the year. You know, everybody starts to go on vacation. You know, the volume in the stock market, the bond market is very light. Your, you know, bid-ask levels are going to be a little bit wider, and you don't want to have to deal with that. So, you know, make sure you get a lot of your trading done really in the first couple weeks of December, because things do really tend to slow down, and volatility could potentially pick up because of that. So anyone, of course, on the call, if you have questions on this, Andy and I are always more than happy to, you know, again, look at your specific situation and see if something like this would make sense. You know, another strategy that we've discussed and that Carol Foose, our CPA in the office, has discussed as well is, you know, the Roth conversion. So if, you know, the Roth has limits on income limits as far as, you know, who can actually contribute to a Roth IRA. But they did a few years ago say, okay, well, if you have a traditional IRA, you can actually convert to a Roth IRA, and there's no income limits on that particular situation. So basically anyone can do that conversion. Okay, so when you do a conversion, however, any of that money in the IRA that has never been taxed, you're going to pay tax on come April or come, you know, later in 2013 when you file your tax returns. So the Roth conversion for a lot of people today, I think, does make sense. You know, we are recommending it. I will tell you that you obviously have to have the cash flow in a couple months out of another pocket to pay the tax bill. So that's really the biggest question you have to ask yourself. Well, oh, sure, I can convert my $100,000 IRA to a Roth, but, you know, I might owe $40,000, $35,000 in tax if I do that, and I need to come up with that cash, you know, again, from another pocket. You can't pay your tax out of your IRA if you're not 59.5, you know, without taking a penalty, without getting that 10% penalty. So again, something that we would be more than happy to discuss, you know, with anybody here on the webinar, something that's been a point of discussion here as well for our clients. I will say there's this third bullet here. It says option to recharacterize. So what really does that mean? Well, what that means is actually you can make the decision to convert this year, and then you have, you know, really until you file your tax return next year, 2013. If for whatever reason the market, you know, really sells off, and that, you know, amount that you converted, that $100,000, is now only worth $80,000, and you're going to owe $40,000 as an example in tax, when you would owe less if you had converted it when it was worth $80,000. You actually have the option to recharacterize your Roth back to a traditional IRA and reverse everything that you did. Again, very good question for your CPA when the time comes. So let's see. You know, lastly, I think one other strategy really for your portfolio to keep it away from that lame duck status, to take some action, whether it be this year or next year, would be to look at other types of investments. Here we list life insurance and annuities. So both of these really give you an opportunity for an account that gives you tax-deferred growth. They're really great to consider to diversify your income streams at retirement, because all of these different accounts are going to be taxed differently when you take money out. So for example, if you have an IRA account, it's when you start pulling money from that account, you're going to pay your ordinary income tax rate at the time. If you have potentially a cash value life insurance that you've funded throughout the years, you actually can take money potentially from the policy, depending how it's set up, as a loan, and you would not owe tax on that money. So that would almost work like a Roth IRA as well, because you put after-tax money in, and when you take everything out, whether it be the after-tax money or the growth, it actually would come out tax-free. So all these are just great ideas, I think, that everybody should make sure they discuss with their advisors. There's so much that can really be done to take advantage of what's really going on. And I think a lot of us probably have advisors. You see the value in an advisor. You don't have the time necessarily to think of all these ideas yourself, and that's why you hire us. What Andy and I do on a regular basis is we're constantly working on new ideas for our clients, whether it be on the investment side, whether it be specific to it, like I said, a stock sector or a strategy or a Roth conversion. We have really great experts at our firm that can answer a lot of these questions, even if we can't. We have CPAs, we have attorneys, we have a couple CFPs and insurance experts on staff, and all of these things are really good ideas to discuss as we go into year-end and in 2013. Again, I think I've already touched on this, but tax-aware investing is going to be so important as we go into the next couple years. Really we know that our taxes have to go up. We're running too much of a deficit. We need more revenues. Taxes are obviously one way to get those revenues, the biggest way to get those revenues. And so when you're investing in your taxable accounts and your LLCs going forward, you really have to figure out and make sure you understand how each investment is taxed, what investment is better to be held in your IRA versus your LLC, as I've already mentioned. It's really called asset location. I think the two biggest things that take away from our returns in our investment portfolios are expenses. So the expenses that your advisor may charge, the expenses that your custodian may charge, that the mutual fund company may charge, and then taxes, right? Because if you, for example, have a bond fund that you own in your IRA account, you're not going to pay tax on all the income that comes in on that on an annual basis or a semi-annual basis. But if you have that same bond fund in your taxable account and income comes in every year, you're actually going to pay your ordinary income tax rate on that income. And so you can see how that's just reducing your return. So why would you hold such an investment in your taxable account? You shouldn't. You should know that it's better positioned in a qualified account like an IRA. I think that's what we really had to discuss today. I know we're coming up on 40 minutes, and we wanted to make sure we kept this brief, and hopefully we answered some of your questions and gave you some great ideas, to really position your portfolio going into 2013. As Andy said, we are cautiously optimistic that there'll be some sort of guidance before the end of the year from the government, and then going into 2013 that something actually does get accomplished. I think we know that a lot of hard decisions have to be made, and it could potentially be a few rough years or a few really good years. There's a lot of cash on the sidelines. We see this every day. We talk to some investors. We listen to earnings conference calls. We see companies just not spending a lot of money. Everybody just needs some clarity. And if we can get some clarity and a little bit of this uncertainty taken care of, I think there's a lot of great potential for the economy and the markets to do well. So with that being said, OJM, Andy told you a little bit about the firm. I think if you ever have questions, you can definitely give us a call, but we have several experts on hand. We take a focused approach to, whether it's tax planning, retirement planning, asset protection. We deal mostly with physicians and business owners, and so we have great experience and backgrounds here. Our partners, Jason Odell and David Mandel, speak at various conferences throughout the year on, various financial topics. So you might have heard one of them or even met them at one of the local conferences. I think they'll be in, I think Jason was saying Philadelphia in February, so probably not a great month to be in Philadelphia, but they're going to be speaking there on their roadshow that they do. And of course, Andy and I are part of a team of the investment professionals that we have on staff as well to advise. So, we just wanted to run a quick poll here for everybody, and if you could just give us an answer as to, maybe the best way to contact you, that would be great. Again, thank you so much for taking the time to listen and to hear us speak tonight. These are always recorded and are available on YouTube. If you, Google, not Google, I guess go to YouTube and type OJM Group. We also have, a Twitter account. You can follow our Twitter account as well. We always post various articles maybe that we write or good tips and topics for our clients. And, we always give a 1-hour free consult to everybody. And we just request that you fill out a few pages of data to get us started, and we learn a little bit about you. And, we have that 1-hour consult with one of our partners or Andy or I, and we go through your various scenarios and, give you the opportunity to hear some good ideas and then, the potential to work with us. So here's our phone number. Here's our emails on this slide. Please feel free to contact us. We look forward to hearing from everybody. And again, from both Andy and I, thank you again for taking the time tonight in your busy schedules to listen to our webinar. And enjoy your night and, of course, have a very happy holiday. Thank you.